White House's 500% tariff. India faces economic destruction tonight. BRICS Retaliation. They told the world this was about trade, about numbers, about deficits. But this decision crossed a line. A tariff so extreme it changes how power is used in the global economy. It forces retaliation, realignment, and silent consequences. What happens next doesn't stay in India, and by the time markets react, it may already be too late. They had seen tariffs before. They had seen trade wars, sanctions, and political pressure disguised as policy. But this was different. When the White House announced a 500% tariff on Indian goods, it was not received as a negotiation tactic. It landed as a shock event, one that immediately raised a deeper question inside boardrooms, banks, and ministries around the world. This was not about correcting trade imbalances. This was about power. A tariff at this scale had almost no precedent among major economies. Historically, even during the most aggressive trade conflicts, tariff levels rarely crossed symbolic thresholds. 10% sent a message, 20% escalated pressure, 50% signaled confrontation. But 500% did something else entirely. It broke the grammar of global trade. From a purely economic perspective, such a tariff functions less like a tax and more like a blockade. At that level, goods do not become more expensive. They become unviable. Supply chains collapse by design. Contracts are canceled overnight. Entire export sectors face immediate paralysis. India was not a marginal trading partner. It was deeply embedded in global production networks. From pharmaceuticals and industrial components to software services and refined materials, Indian exports fed into Western supply chains that depended on scale, reliability, and cost efficiency. A 500% tariff did not target a single sector. It threatened the architecture itself. Inside the White House, the announcement was framed as a necessary defensive measure. Public statements emphasized sovereignty, fairness, and national interest. The language was firm but vague. There was no detailed economic justification that matched the magnitude of the action. That absence mattered. Markets noticed inconsistencies. Institutions noticed silence. Within hours, analysts began modeling the real impact. If enforced fully, the tariff would erase competitiveness instantly. Importers would shift sourcing. Multinationals would pause expansion plans. Investors would reassess exposure. Currency traders would price in risk before fundamentals caught up. But the deeper concern was not India's immediate loss. It was the signal being sent. For decades, global trade operated on a shared assumption. Tariffs were tools, not weapons. Even when misused, they remained bounded by economic logic. This decision challenged that assumption. It suggested that access to markets could be revoked not by multilateral consensus, but by unilateral force. That shift carried consequences far beyond India. Business leaders understood what this meant. If a country of India's size and strategic importance could face a 500% tariff, then no supply chain was truly insulated. No emerging market partnership was guaranteed. Political alignment, not efficiency, suddenly appeared to be the new currency of trade. The immediate numbers were staggering. Indian exports to the United States represented tens of billions of dollars annually. Entire clusters, textiles, gems, engineering goods, and digital services depended on that access. A tariff of this scale threatened employment, revenue stability, and investment confidence all at once. Yet the shock was not limited to exporters. American companies reliant on Indian inputs faced sudden cost explosions. Contracts written months earlier became unworkable overnight. Shareholders demanded answers. Procurement teams scrambled. The idea that tariffs protect domestic industry rang hollow when domestic firms were the first to feel the disruption. In financial markets, reaction often precedes explanation. Risk models do not wait for press conferences. They respond to volatility signals, policy unpredictability, and escalation patterns. The tariff announcement triggered all three. Capital flows tend to retreat from uncertainty. Pension funds, sovereign wealth funds, and long-term investors seek predictability above all else. A 500% tariff suggested that predictability was no longer guaranteed, even among partners once considered stable. This was the moment when the story shifted. What began as a headline about India quietly became a warning about the system itself. If trade rules could be rewritten this abruptly, then the safeguards built after decades of globalization were weaker than assumed. Economists began referencing historical inflection points. The breakdown of fixed exchange rates, the collapse of consensus trade regimes, moments when a single policy choice accelerated structural change. This tariff, many argued, belonged in that category. The question was no longer whether India could absorb the shock. The question was whether the global system could absorb the precedent. Inside policy circles, a more uncomfortable thought emerged. When economic tools are used without proportional restraint, they invite counter-architecture. Nations adapt, they diversify, they build alternatives. Pressure does not always produce compliance. Sometimes it produces alignment elsewhere. That realization would soon matter, because this tariff did not exist in isolation. It arrived in a world already fragmenting. where trust in institutions was thinning and parallel systems were quietly taking shape. For countries watching from the sidelines, the lesson was clear. Dependence carried risk. Neutrality offered no immunity. For entrepreneurs and business leaders, the implications were immediate. Strategies built on global integration assumed continuity. That assumption was now questionable. Exposure had to be reassessed. Concentration risk reevaluated. Political variables moved from footnotes to front pages. And yet, something unexpected happened next. India did not rush to negotiate. It did not issue threats. It did not blink. That silence unsettled markets more than retaliation ever could. They had heard the official explanation many times. The tariff, they were told, was about fairness, about discipline, about protecting national interests. But among economists, diplomats, and senior market analysts, a different conversation was taking place. One that did not fit neatly into press releases or public statements, because when the numbers were examined closely, the justification no longer matched the action. A 500% tariff could not be explained by trade imbalance alone. No economic model supported it. No historical precedent justified it. The scale suggested something else was at work. This was not trade policy. This was leverage. In modern geopolitics, power is rarely exercised openly. Military conflict is costly and unpredictable. Sanctions draw backlash. Diplomacy requires compromise. Tariffs, however, offer something different. They appear legal, procedural, and domestic, while delivering external punishment. That distinction mattered. Within policy circles, there was growing recognition that economic tools were being repurposed. What once existed to regulate commerce was now being used to enforce hierarchy. Access to markets was becoming conditional, not on efficiency, but on alignment. India's position complicated this shift. It was not an adversary, it was not a dependent state, and it was not easily replaceable. India had spent years balancing relationships carefully. It traded with the West while maintaining strategic autonomy. It engaged with global institutions while refusing to bind itself fully to any single bloc. This posture had long been tolerated, in some cases even respected. But tolerance has limits when power feels challenged. Analysts began tracing the timeline. Diplomatic friction had been building quietly. Disagreements were downplayed publicly, but they accumulated beneath the surface. Strategic decisions taken by India signaled independence rather than obedience. In a system accustomed to influence, independence can be misread as defiance. That is when tariffs change character. Historically, tariffs were negotiated. They were reduced, adjusted, and traded for concessions. They existed within a shared framework. But once tariffs become punitive, they lose their economic logic. Their purpose shifts from correction to demonstration. Demonstration of authority, demonstration of consequence. Inside global financial institutions, the message was understood clearly. When a dominant economy uses tariffs this aggressively, it is not seeking compromise, it is testing boundaries, it is asking how far resistance will go. This is where risk multiplies. Because when economic policy becomes personal or political, predictability disappears. Markets can adapt to bad policy. They cannot adapt to arbitrary policy. Investors price inconsistency, not fairness. Once decisions appear driven by prestige or retaliation, confidence erodes rapidly. There was another signal that troubled observers. The tariff was announced without a multilateral process. No arbitration, no coordinated framework. It bypassed institutions designed to manage disputes. That bypass was not accidental. It reflected a belief that rules were optional when power was sufficient. For countries watching closely, this raised an urgent question. If rules no longer protected partners, then partnerships were fragile by default. Economic planning based on long-term access became risky overnight. This is how fragmentation begins, not with declarations, but with doubt. India understood this. Its policymakers recognized that immediate retaliation would miss the deeper issue. Counter-tariffs would validate the framework of escalation. Negotiation under pressure would confirm the effectiveness of coercion. Instead, India assessed the situation differently. The issue was not the tariff itself. The issue was the precedent it set. If India conceded, it would normalize economic punishment as an acceptable diplomatic response. If it resisted recklessly, it risked destabilizing its own economy. The response required patience, not impulse. This calculation surprised many. Most developing economies faced with extreme pressure seek rapid resolution. They offer access, incentives, or alignment. India did none of these publicly. That restraint signaled something important to the global system. It signaled confidence. Not confidence in immunity, but confidence in options. India had alternatives, markets to diversify into, partners willing to engage, an internal demand capable of absorbing shocks. It was not invulnerable, but it was not trapped. This reality unsettled assumptions in Washington and on Wall Street alike. The tariff was designed to force movement. Instead, it exposed limits. The deeper danger, however, lay elsewhere. When economic punishment fails to produce submission, it encourages adaptation. Countries begin to reduce exposure. They build redundancy. They explore parallel systems. What starts as resistance evolves into reconfiguration. That is how influence erodes. Not because power disappears, but because dependence declines. For business leaders and entrepreneurs, this phase is the most dangerous. The shift is subtle. Contracts still exist, payments still clear, trade still flows, but beneath the surface, incentives change. Risk is reassigned, trust is recalculated. Those who notice early adjust. Those who do not are caught later. By the end of the week, one fact was clear. The tariff had not isolated India. It had isolated the assumption that economic dominance alone guaranteed compliance, and in response, a quieter process had already begun. Most analysts expected a familiar pattern, a strong statement, a rushed delegation, an urgent round of negotiations. That is how trade confrontations usually unfold, especially when the pressure is extreme. Governments signal outrage, markets panic, and behind closed doors, concessions are quietly explored. Now, the objective is speed. Damage control becomes the priority. But this time, the expected response never came. India did not issue a dramatic counter-threat. It did not announce emergency tariffs. It did not appeal loudly to international arbiters. Instead, there was restraint. From the outside, this appeared passive. In reality, it was calculated. Silence in strategic economics can be more disruptive than retaliation. It denies the initiator the feedback loop they expect. It creates uncertainty where leverage was supposed to produce compliance. Within India's economic institutions, the reaction was methodical rather than emotional. Policymakers focused first on containment. Exporters were briefed. Banks assessed exposure. Currency stabilization measures were prepared quietly. The goal was not to deny the shock, but to absorb it without signaling weakness. This approach surprised global markets. A 500% tariff should have triggered panic, yet capital flight remained limited. The currency softened but did not collapse. Equity markets showed stress but not disorder. This contradicted the narrative that India was uniquely vulnerable. The reason lay in structure. India's economy was not built around a single export dependency. While access to the American market mattered, it was not existential. Domestic demand, regional trade, and services exports provided buffers. The shock was painful but not fatal. More importantly, India had spent years diversifying quietly. Trade agreements across Asia, the Middle East, and Africa reduced reliance on any single destination. Supply chains that once flowed westward had already begun branching outward. This was not a reaction to the tariff. It was preparation. Markets began to recognize this. As days passed without escalation, assumptions shifted. Investors realized that immediate capitulation was unlikely. The tariff was not producing visible cracks. That realization altered the power dynamic. Economic pressure works best when outcomes are predictable. When pressure meets uncertainty, its effectiveness declines. India's restraint also sent a signal beyond economics. It demonstrated political resolve without provocation. By avoiding public confrontation, it denied the tariff its intended narrative. There was no dramatic standoff to frame as victory or dominance. Instead, there was quiet recalibration. Inside boardrooms across emerging markets, this was noted carefully. If India could absorb such pressure without surrender or collapse, others could too. The lesson was not about resistance. It was about preparation. At the same time, India's response carried risk. Prolonged tariffs would strain employment, reduce export earnings, and slow growth. This was not a painless strategy. It was a long game. The choice reflected a broader understanding. The immediate damage of tariffs could be measured. The long-term damage of dependence could not. Rather than rushing to preserve access, India began reinforcing alternatives. Exporters were encouraged to explore new markets. Payment systems were adjusted. Trade settlement discussions accelerated with non-Western partners. None of this was announced loudly. That was intentional. Markets often react to headlines. Systems change quietly. As weeks passed, something else became evident. The absence of dramatic retaliation reduced volatility. Without escalation, there was no feedback loop to amplify fear. This stabilized conditions enough for planning to continue. For global investors, this posed a dilemma. The tariff signaled hostility, but India's response signaled resilience. Which signal mattered more? The answer depended on time horizon. Short-term traders focused on risk. Long-term capital looked at adaptability. Entrepreneurs watching closely understood the implications. Economic resilience was no longer just about scale or growth rates. It was about optionality, the ability to reroute, renegotiate, and reconfigure when pressure arrives. India's response highlighted this shift. By refusing to react impulsively, it reframed the confrontation. The tariff was no longer a demand. It became a test of endurance, and endurance favored those who had prepared. This recalibration did not resolve the conflict. It changed its nature. The question was no longer whether India would respond. The question was how the system would respond. Because when one country absorbs extreme pressure without breaking, others begin to imagine alternatives. They begin to explore cooperation beyond traditional centers. They begin to ask whether dependence is a liability rather than an asset. This is how quiet resistance becomes collective momentum. And as India maintained its course, that momentum started to take shape elsewhere. What followed was not announced. It did not arrive as a press conference or a treaty. It unfolded quietly across balance sheets, payment systems, and trade routes. When extreme economic pressure fails to force submission, systems adapt. This is not ideological, it is mechanical. Markets, institutions, and states respond to incentives. And the incentive created by a 500% tariff was clear: reduce exposure. India's restraint did not exist in isolation. Other countries were watching closely, especially those already questioning the reliability of existing trade and financial structures. The lesson was not about confrontation, it was about insulation. Inside the group of emerging economies often described as BRICS, conversations that once felt theoretical became practical. For years, discussions around alternative trade settlement, local currency use, and reduced dependence on Western financial plumbing had moved slowly. The tariff accelerated them, not because of ideology, because of risk management. When access to a dominant market can be restricted unilaterally, concentration becomes a liability. Businesses and governments begin asking the same question: what happens if this happens to us? That question changes behavior. Trade does not disappear overnight. Instead, it reroutes. Settlement mechanisms are adjusted. Currency exposure is diversified. Contracts are rewritten with contingency clauses. What looks like marginal change accumulates into structural shift. This is how parallel systems emerge. Not as rebellion, but as redundancy. India's situation provided a case study. The tariff showed that economic integration without safeguards exposes economies to political shock. In response, efforts to increase intra-regional trade gained urgency. Payment systems that bypassed traditional clearing routes received renewed attention. Local currency settlements moved from pilot projects to active negotiation. None of this was framed as retaliation. That would have invited escalation. It was framed as resilience. For global finance, this matters deeply. The existing system relies on trust, predictability, and central nodes. When those nodes are perceived as tools of pressure rather than neutral infrastructure, participants seek alternatives. Even partial alternatives reduce leverage. This does not mean collapse. It means dilution. For decades, the global system benefited from inertia. Switching costs were high. Coordination was complex. But technology reduced friction. Political pressure increased motivation. Together, they altered the equation. Investors began factoring this into long-term models. Not as an immediate crisis, but as a gradual reallocation of risk. Exposure to single market dependence was reevaluated. Supply chains optimized for cost were reassessed for resilience. This had consequences for retirement funds, sovereign portfolios, and institutional capital. Long-term returns depend on stability. When stability is questioned, diversification becomes defensive rather than optional. Entrepreneurs felt this shift earlier than most. Businesses operating across borders began reassessing where they manufactured, settled payments, and held reserves. Decisions that once prioritized efficiency now prioritized optionality. Redundancy, once viewed as wasteful, became strategic. The tariff's most significant impact was not the revenue it threatened. It was the behavior it changed. Pressure that forces adaptation weakens future pressure. This is the paradox of economic coercion. It may produce immediate disruption, but it accelerates independence over time. Each shock encourages insulation. Each insulation reduces leverage. India's role in this process was pivotal, not because it sought leadership, but because of scale. A smaller economy might absorb pressure quietly. A larger one reshapes incentives for others. India's market size, production capacity, and geopolitical relevance made its response instructive. As alternative arrangements gained traction, confidence in existing assumptions eroded slightly, but persistently. No single decision caused this. It was cumulative. 1,000 small adjustments rather than one dramatic break. For decision makers, this was the real warning. The tariff was a headline. The adaptation was the story. Those who focused only on the immediate confrontation missed the deeper transformation. The world was not splitting cleanly into blocks. It was becoming modular, interconnected but less centralized, integrated but less dependent. This environment rewards foresight. Businesses that anticipate fragmentation adjust early. Those that assume continuity react late. In strategic economics, timing determines survival. By the time markets fully price in structural change, options narrow. The early signals are subtle. They appear as policy experiments, trade dialogues, and quiet coordination. The tariff accelerated all of them. What began as a unilateral act revealed a collective vulnerability. And vulnerability, once recognized, drives innovation. The system was not collapsing. It was recalibrating. And in that recalibration, power was no longer exercised only through access. It was contested through alternatives. The tariff was meant to assert dominance. Instead, it exposed a limit. The next phase would not be loud, but it would be irreversible.